Many young people ask me the absolute secret to building massive lifelong wealth, and I tell them the truth, but nobody wants to believe it. Everyone loves the comforting lie of a simple, predictable domestic market, while their actual economic future is dictated by massive geopolitical gears turning behind closed doors. We have been conditioned to look at our personal brokerage accounts in complete isolation without ever understanding the plumbing of the global monetary network. Every single unexamined financial assumption you harbor is a direct threat to your future freedom and your ability to preserve your capital. I was recently analyzing some incredibly heavy institutional movements happening between foreign central banks and the United States Treasury. If you actually look at the raw empirical data through a clear mathematical lens, you realize that the standard economic narrative is completely broken. The mainstream financial media loves to scream about daily stock market fluctuations while completely ignoring a massive invisible war happening in the global bond market. What is happening right now with international currency flows will completely define the purchasing power of your money over the next 12 months. My name is Dean Si, and I look at the financial matrix through the lens of pure logic, probability, and structural mechanics. I watched how retail investors panic over small local indicators, while massive sovereign nations are quietly staring down an unprecedented liquidity crunch. Our mission today is to tear down the walls of corporate financial jargon so you can understand the actual rules of the global wealth game. The mainstream advisory complexes will never tell you the truth because keeping you focused on minor details keeps you from seeing the structural cracks in the system. In April, the United Arab Emirates, which is easily one of the wealthiest geographic territories on Earth, approached the United States Treasury for a financial lifeline. If you strip away all the polite diplomatic terminology, their core message to Washington was brutally simple and incredibly alarming. They basically told the United States government to help them secure immediate liquidity, or they would have no choice but to crash the American bond market. 2 weeks ago, I explained to my audience that the United States was actively fighting two distinct economic wars simultaneously. There is one overt conflict that you can easily see on the evening news, and there is an invisible monetary conflict that you cannot see. Last week, this silent, invisible war drew its first real institutional blood, and you need to pay incredibly close attention to this sequence. There is a massive structural vulnerability in the United States Treasury market that most everyday retail investors never think about. When the United States government consistently spends significantly more money than it collects in taxes, it must borrow the difference to pay its bills. It accomplishes this by issuing and selling massive quantities of government IOs, which the financial industry calls treasury bonds. A standard 10-year treasury bond is a simple mathematical promise from the American government to pay you back in 10 years with regular interest payments. For decades, these bonds have been universally considered the safest foundational asset in the entire world, because the government can always print currency to pay its debts. Because of this perceived safety net, foreign nations like Japan, the United Kingdom, China, and South Korea currently hold roughly $9.4 trillion of these American IOs. Foreign governments bought these specific bonds because they are incredibly liquid, safe, and denominated in the ultimate global reserve currency, which is the United States dollar. For over 40 years, this grand monetary system worked beautifully, because the United States could borrow capital at incredibly cheap interest rates. Meanwhile, foreign governments had a massive secure digital vault where they could park their excess national savings and earn a predictable yield. This entire configuration is completely flawless until you enter a historical situation where every single participant suddenly needs their cash back at the exact same moment. Let us look at this problem through a practical behavioral lens and ask a very simple question about survival. If you were currently managing the Central Bank of Japan and your nation was staring down an existential energy crisis that threatened to shut down your domestic factories, if your shipping routes were compromised and you desperately needed physical United States dollars immediately to purchase crude oil on the open market, what would you do? You would immediately look at your balance sheet and sell your most liquid dollar-denominated asset as fast as humanly possible to raise the cash. You would not hesitate for a single second. You would instantly begin liquidating your massive hoard of United States Treasury bonds. That exact scenario is precisely what is beginning to manifest across the global banking mechanism right now as we speak. A massive quantity of foreign nations have been severely impacted by the structural closure of the Strait of Hormuz, which cut off their baseline energy supplies. These countries desperately need to raise immediate dollar liquidity to purchase alternative fuel sources on the volatile open market. Because of this frantic scramble for cash, foreign central bank holdings of American treasuries parked at the New York Federal Reserve have collapsed to their lowest levels since 2012. Nations that are critically short on energy and desperate for reserve currency are dumping American government bonds into the open market to survive. Japan currently controls over $1.2 trillion in treasuries, and the United Kingdom holds roughly $895 billion. These are not small, insignificant retail positions. These are massive structural pillars of the global financial architecture. Here is the catastrophic mathematical problem that arises when multiple massive entities attempt to exit the exact same door at the exact same time. When an overwhelming volume of participants sell the exact same asset simultaneously, the market price of that asset drops precipitously. When the market price of a fixed income treasury bond drops its effective interest rate, which Wall Street calls the bond yield, automatically spikes upward. That bond yield represents the exact mathematical incentive that investors demand to lend their hard-earned capital to the United States government. Because Treasury yields serve as the absolute baseline foundation for borrowing costs across the entire global economy, everything instantly becomes significantly more expensive. We are talking about your personal housing mortgages, your consumer car loans, your corporate debts, and government refinancing costs, all climbing simultaneously. Let us take a brief moment to break this exact institutional bond mechanism down into simple everyday terms so you can see the math clearly. Put yourself directly in the shoes of the United States government, where you consistently spend far more money than you actually pull in. You need to secure a new loan immediately, just to keep the lights on and pay your ongoing baseline operational bills. Let us say I decide to loan you $1,000 today, and you agree to pay me a 5% annual interest rate for 5 years. That means I will receive $50 of passive income every single year, and I expect to receive my original $1,000 back at the end of the term. On paper, that looks like an incredibly stable, predictable deal for both parties involved in the transaction. But imagine that 2 years into this 5-year agreement, I experience a sudden emergency cash call in my personal life, and I need my money back immediately. The obvious structural problem is that you do not legally owe me that principal balance back for another 3 full years because it was a 5-year note. So I am forced to go out into the open marketplace to find a third-party investor who is willing to buy your loan note from me. I locate an independent investor and explain that the United States government owes me $1,000 and is paying a steady 5% interest rate. I inform them that the full principal is due in 3 years, but because I have an emergency today, I need to liquidate the asset immediately. I offer to transfer all future interest payments, and the final $1,000 principal payout to them if they give me cash right now. The problem is that this third-party investor is highly sophisticated, and they can easily smell my financial desperation from a mile away. They know perfectly well that I am a forced seller who needs liquid currency today to solve an immediate external crisis. So they look at my $1,000 loan note and tell me they will buy it, but they absolutely refuse to give me the full face value they offer to pay me a discounted price of $800 today for that specific $1,000 government obligation. Because I am desperate for immediate liquidity and have no alternative options, I am forced to accept the discount and take the $800. Let us analyze the exact mathematical reality of what just occurred in this transaction from the perspective of that third-party buyer. That clever investor just deployed $800 of capital to acquire a debt asset that will pay them $1,000 in 3 years. They are also collecting the $50 of annual interest along the way, which means their effective investment return has scaled up dramatically. Their yield went up significantly, simply because they paid a lower entry price for the exact same underlying stream of future cash flows. Now I want you to imagine this exact mathematical phenomenon occurring at an absolute global scale across the entire financial system. We are no longer talking about a single retail lender looking for $800, we are talking about entire sovereign nations. Japan, the United Kingdom, and South Korea are all simultaneously desperate for immediate liquid dollars to purchase physical energy supplies. They are all dumping massive blocks of United States Treasury bonds into the open market at the exact same historical moment. They are all perfectly willing to accept less than full face value for these bonds because their domestic survival requires immediate liquid cash. We are absolutely not talking about billions of dollars anymore. We are talking about multiple trillions of dollars moving across central bank ledgers. Why exactly is this sudden global liquidation an absolute nightmare scenario for the domestic American economy? It is a massive systemic issue because the United States government is still actively spending trillions of dollars more than it actually earns. Therefore, the Treasury must continuously issue and sell brand new bonds every single week to secure fresh loans from the public. But if a sophisticated institutional investor can walk into the open market and buy an existing Treasury bond at a massive discount for $800, why on earth would that investor hand the United States government a full $1,000 for a brand new bond that pays the exact same interest? They obviously would not do that because nobody in the financial world operates as a charitable institution for sovereign nations. Therefore, the United States government is legally forced to offer significantly higher interest rates on all new bond issues just to attract capital. This means the structural cost of borrowing spikes aggressively for the government itself at the exact historical moment when it can least afford it. Because Treasury yields dictate the absolute baseline floor for almost every single interest rate in the modern economy, everything explodes in cost simultaneously. Suddenly, consumer mortgages, car loans, corporate debt lines, and regional banking operations face massive tightening pressures all at once. This is the ultimate macroeconomic predicament facing the monetary authorities in Washington today. The United States absolutely must offer elevated interest rates to incentivize foreign capital to continue funding its massive deficit spending, but paradoxically, those exact same elevated interest rates will ultimately break the back of its own domestic economy and real estate markets. This brings us directly to why the sudden movement of the United Arab Emirates matters so much to your personal portfolio today. In late April, the United Arab Emirates quietly approached the United States Treasury and demanded an immediate wartime financial lifeline. The United Arab Emirates is one of those major foreign institutional holders of American sovereign debt that we were just discussing. The critical maritime trade route known as the Strait of Hormuz has been effectively blocked for approximately 12 full weeks. That structural disruption means the United Arab Emirates cannot export and sell their physical crude oil at their typical historical volumes. They have massive ongoing international bills to pay, but their primary revenue generation engine has been temporarily paralyzed by geopolitical conflict. Here is the crucial nuance that you must comprehend, because the mainstream media headlines will completely misrepresent this situation. The United Arab Emirates is a fabulously wealthy nation that possesses an unbelievable volume of long-term global financial assets. They have absolutely not run out of money in the conventional sense that a retail consumer understands bankruptcy. They currently hold roughly $95.2 billion in liquid United States Treasury bonds alone on their national balance sheet. They control approximately $270 billion in traditional foreign exchange reserves across their central banking system. Furthermore, they command multiple trillions of dollars in additional wealth through their massive sovereign wealth funds like the Abu Dhabi Investment Authority. So the nation is far from being broke, but their immediate short-term liquid dollar cash flow has experienced a sudden violent interruption. When your ongoing cash flow drops to zero, you are naturally forced to dip directly into your accumulated savings to cover your overhead. But if the United Arab Emirates had manually dipped into their savings by selling their American treasuries into the open market to raise dollars, that action would have meant unloading tens of billions of dollars of sovereign debt onto an already highly stressed and volatile bond market. The market price of those bonds would have cratered, instantly causing the yield on the 10-year Treasury to spike violently into the danger zone. The United Arab Emirates would have single-handedly triggered the exact destructive debt spiral that the Federal Reserve is terrified of facing. So instead of executing a forced liquidation in the open market, their financial authorities flew to Washington with a completely different proposition. They explicitly told the United States government that they did not ask for this regional conflict and were dragged into it by external forces. They stated that if they ran short on immediate liquid dollars and Washington refused to provide assistance, they would have no choice but to raise it themselves. They openly reminded the Treasury exactly what that forced liquidation would mean for the stability of the American domestic bond market. In order to avoid a total systemic meltdown, the United Arab Emirates requested a short-term emergency facility known as a currency swap line. A currency swap line is an emergency institutional credit facility that allows the Federal Reserve to lend physical dollars directly to a foreign central bank. You must understand that this arrangement is absolutely not a charitable bailout of the United Arab Emirates economy. I look at this mechanism as an immediate defensive bailout of the United States Treasury market itself to prevent a forced liquidation event. Let us take a deliberate minute to dissect exactly how currency swap lines function, because this mechanism will dominate financial news headlines over the next year. The United States Federal Reserve agrees to credit a specified volume of physical dollars directly to the ledger of a foreign central bank. In exchange for those dollars, the foreign central bank pledges an equivalent value of its own domestic currency as collateral to the Federal Reserve. This entire transactional swap is locked in using a completely fixed exchange rate that is determined at the exact inception of the loan contract. When the swap agreement reaches its official maturity date, the foreign central bank returns the physical dollars along with a specified interest payment. The exchange rate used at the maturity of the loan is identical to the starting rate, regardless of how the two currencies fluctuated in the open market. If you look at the historical data, every single emergency swap line extended during the crashes of 2008 and 2020 was technically repaid. But I use the term technically repaid with an incredible amount of skepticism, because the underlying institutional reality is far more complicated. In 2013, the Federal Reserve quietly altered the fundamental terms of its swap arrangements with 5 major central banks around the world. They permanently shifted those emergency facilities from temporary short-term crisis loans into permanent standing monetary agreements that never expire. I am not entirely sure there is a meaningful structural difference between a loan that never gets paid back and a loan that never actually matures. I will leave that specific philosophical question for you to evaluate as you protect your own personal capital from currency devaluation. I do have a highly precise macroeconomic prediction regarding how this mechanism will unfold over the next 12 months of market activity. The currency swap line program is going to expand dramatically across the globe as the international dollar shortage intensifies due to trade disruptions. With that expansion, the official roster of foreign nations that the United States accepts systemic responsibility for will grow to unprecedented levels. If my structural analysis is correct, we are about to witness two very distinct phenomena manifest inside the global banking system. First, the specific list of countries that Washington deems eligible for emergency dollar swap lines will expand far beyond traditional core allies. Historically, these lines were strictly reserved for stable entities, like the European Central Bank, the Bank of Japan, and the Bank of England. Moving forward, we will see this emergency net extended to much less reliable partners who possess significantly less stable domestic fiat currencies. As the official institutional eligibility criteria drops, the underlying credit risk and structural fragility of these massive loans will skyrocket. Second, the total volume of temporary swap lines that quietly transition into permanent rolling debt obligations will expand significantly. In that type of highly manipulative monetary environment, these emergency loans never actually get liquidated or cleared from the balance sheet in any real sense. They simply get rolled over continuously through a highly sophisticated accounting parlor trick orchestrated by central bankers. The Federal Reserve simply extends the maturity date and the foreign borrower draws down a brand new swap line to technically pay off the old one. Each individual transaction appears perfectly clean and paid in full on the official accounting ledgers to satisfy public scrutiny, but the aggregate outstanding balance of dollars extended to foreign entities never actually decreases by a single penny over time. Coincidentally, the professional analysts on Wall Street have a beautifully deceptive term for this specific institutional phenomenon. They call it the amend, extend, and pretend strategy, because it perfectly describes the behavioral pattern of the institutions. You manually amend the legal terms of the bad loan to extend the payment deadline so you can pretend that everything is perfectly fine. The empirical evidence that my prediction is actively materializing across the global financial system will be incredibly simple to track. First, the Federal Reserve will officially approve the emergency currency swap line for the United Arab Emirates to protect the bond market. Immediately following that announcement, the nation of Kuwait is going to step forward and demand the exact same institutional dollar lifeline from Washington. Why exactly will Kuwait be the next major domino to fall in this international liquidity scramble? Because raw crude oil export revenues fund roughly 90% of the